Section 4, the breaking point, 1929. And the template for modern crises, the Great Depression, is often described as a cautionary tale, but it also set the blueprint. After the 1929 crash, small banks collapsed by the thousands, family businesses vanished, unemployment soared. But major financial institutions survived and consolidated. Why? Because governments intervened. Central banks expanded. Emergency programs stabilized key institutions. New regulations raised barriers to entry. The result? More centralized, more concentrated financial system. The lesson was clear. Crises eliminate competitors and justify intervention. Intervention protects the largest players. This template would repeat again and again. Section 5, the modern era, when collapses became managed events. By the late 20th century, collapses were no longer allowed to run their course. Central banks had a new mandate: prevent total failure at all costs. This meant cutting interest rates, injecting liquidity, backstopping markets, rescuing systemically important institutions. But systemically important didn't mean important to people. It meant important to markets. And markets are dominated by the largest players. So when the 2008 financial crisis hit, homeowners lost houses, workers lost jobs, retirees lost savings, but banks were bailed out. Financial institutions were stabilized. Executives kept bonuses. Trillions were created to prevent collapse. But nearly all of it flowed through financial channels. Asset prices recovered quickly. Cages did not. Ownership shifted upward again. The same few benefited. Section 6, the fallout. Why the same few always win. Every collapse follows the same stages. 1. Liquidity disappears, credit freezes. Markets panic. 2. Forced selling begins, households and small businesses sell assets to survive. 3. Prices collapse, assets fall below intrinsic value. 4. Intervention arrives, central banks inject money. Governments guarantee stability. 5. Capital consolidates, those with access to cheap money buy everything. Public bears losses. The system preserves itself. And because the system is structured to protect scale, the largest players always emerge stronger. This isn't corruption in the traditional sense. Section 7.
Failed fixes. WHY reforms never change the outcome.
After every collapse, reforms are promised. Better oversight, stricter rules, safer systems. But the outcomes never change. Why? Because the core mechanisms remain untouched. Money is created through debt. Access to credit is unequal. Central banks prioritize stability over fairness. Asset markets are protected before labor markets. Reforms tweak the surface, but preserve the structure. And the structure rewards those already positioned at the top. Section 8. Modern parallels. The pattern continues. Look at recent history. After 2008, the wealthiest 1% recovered faster than ever. After 2020, global billionaires increased wealth, while millions fell into poverty. After every rate shock, asset holders adapt while wage earners struggle. Global debt now exceeds $315 trillion. Central banks hold unprecedented power. Markets expect rescue. Every collapse becomes predictable. It's not in timing, but in outcome. 3 takeaways. 1. Financial collapses don't destroy wealth, they transfer it. Ownership shifts upward during every crisis. 2. Access to capital determines winners. Those closest to money creation benefit most. 3. The system protects itself, not the public. Stability for markets often means sacrifice for people. Final warning: a system where collapses always benefit the same few is not unstable, it's highly efficient. But it's efficient at concentrating power. And systems built on endless consolidation eventually face a reckoning, not from collapse, but from imbalance. The question isn't whether another collapse will happen. It's whether the outcome will ever change. Call to action if you want to understand how financial systems really work and why crises keep rewarding the same players. Like, subscribe and turn on notifications, because the next collapse isn't a mystery. Only the lesson is. Every financial collapse is sold as a tragedy. Jobs are lost, savings evaporate, pensions shrink, entire economies stumble. And yet every time this happens, something strange follows. While millions struggle to recover, a small, familiar group emerges stronger than before. Bigger balance sheets, more assets, greater influence. The public story says collapses are chaotic, unpredictable accidents, but the outcome is always eerily consistent. So here's the question most people never ask. If financial collapses are failures, why do they keep rewarding the same few winners? Is it luck? Better planning? Superior intelligence? Or is there something built into the financial system itself? A mechanism that quietly transfers wealth and power upward every time the economy breaks. Today, we're uncovering why every financial collapse, from centuries past to the present day, ends up benefiting the same few, and why this pattern is not an accident but a feature. Section 1, setting the stage. The myth of random collapse.
Most people are taught a simple explanation for financial crises.
Bad decisions, greedy individuals, unexpected shocks, bubbles that got out of hand. According to this story, collapses are unfortunate but unavoidable byproducts of progress. But history tells a different story. Because while the triggers of collapses, change wars, pandemics, housing bubbles, tech manias, the outcomes do not. After every major crisis, ownership concentrates. Markets centralize regulations, favor incumbents, debt increases, and the financial elite expand their control. This consistency suggests design, not randomness. To understand why, we need to go back to when modern financial systems were first built and who they were built for. Section 2, the origins. When finance was designed to survive collapse in the early days of banking, collapses were common and brutal. Banks failed. Depositors lost everything. Credit vanished overnight. But the wealthiest financiers learned quickly, discovered a crucial insight. The real danger wasn't collapse itself, it was being exposed to it. So they redesigned the system. By the 18th and 19th centuries, governments began partnering with major banks to stabilize credit during crises. Central banks emerged, not to protect citizens, but to protect the financial system. This created an early divide. Small banks failed, large banks were rescued, private losses became public burdens, crises became filters, weak players were wiped out, strong players absorbed their assets at discounted prices. And governments terrified of economic chaos stepped in to guarantee survival for the largest institutions. This was the birth of the collapse advantage. From that point forward, financial power didn't fear collapse, it prepared for it. Section 3, the rise. How collapses became opportunities as financial systems matured. Collapses stopped being existential threats and became strategic moments. Here's how the process works. During economic expansions, credit is cheap. Leverage increases, asset prices inflate, debt accumulates. Those closest to credit banks, funds, institutions grow rapidly. Then something breaks. It could be a market bubble, a geopolitical shock, a health crisis, a sudden tightening of liquidity. Asset prices collapse. And this is where the advantage appears, because while the public is forced to sell to survive, those with access to capital can buy everything cheaply. Land, companies, stocks, bonds. Entire industries collapses transfer ownership. And ownership is power. By the early 20th century, this pattern was so reliable that financiers openly prepared for downturns, not to avoid them, but to exploit them.